how should advisors approach security-backed lending? I'm joined by SyntheticFi's Tony Yang to learn more. Tony, thanks so much for joining me.
Shannon, thank you for having me.
So, really interesting topic in our space right now, obviously, when it comes to securities-backed lending, because advisors often struggle to help clients access liquidity without triggering taxes or selling appreciated assets. How should they be approaching that challenge today?
That's a great question. The stocks market have done so well in the past decade. Most clients have large embedded capital gains positions. And we see more advisors these days deploying advanced strategies, such as long-short based tax-aware portfolio tools. And with all those things, it's harder and harder to sell stocks. But the clients need money for their day-to-day expenses. They need to buy the house or the vacation home they want. But the biggest challenge we see right now is just with interest rates. It's just much, much higher than their previous level back in 2020 to 2021, went from 0 to 6%. Most advisors we work with are much easier at the time back in 2020 to tell clients, hey, borrow for nothing, and then don't sell your investments. Nowadays, it's to justify paying a 6, 7, 8% interest rate. And sometimes when you are working with banks on these loans, they don't even lend against those long-short strategies due to the leverage involved. That really makes the advisor's job difficult. And that's actually something we help with here at SyntheticFi to bring the interest rates lower, near the risk-free level. We lend around a little bit over 4%, all fees inclusive. And then we also offer the ability to borrow against those long-short portfolios that banks usually don't touch. So that advisors can deploy this, knowing that their clients would have an exit path, or at least a way to get liquidity while their portfolio are doing their thing, and to generate the capital losses they need.
It helps take the pressure off a little bit, certainly. But when advisors look at securities-backed lending, they're usually comparing cost, speed, flexibility even. Where do you see the biggest gaps in the current options?
There are a lot of good compelling options out there for securities-backed loans provided by banks. We're familiar with quite a few. They work with custodians. They have a process. I think there are gaps in all three areas. On cost, what we see is banks usually have a pretty sophisticated schedule they have in the back of their pocket. They're doing the negotiation thing to figure out, what the client can get based on how rich they are. And if you're working with clients that aren't exactly worth tens of millions of dollars, sometimes you're out of luck because banks don't like that business. So what we offer at SyntheticFi is to help them tap into a market called the box spread market. Those are exchange-traded instruments where advisor can help their clients get their securities-backed loans on exchange. And on exchange, everybody gets the best pricing. It's transparent, it's market priced. And that's usually 1 to 2% lower than banks can offer for most of their client base. There's also an after-tax aspect. I'm a financial planning nerd, so I like to think about both the sort of the sticker price, but also what it means when all the factors are considered. With taxes, I think a lot of the challenges advisors are facing is just they're not able to write off the interest charges on these loans. Clients are often attached to okay, I can write off the interest on my mortgage, at least to some extent, and it's a bit unfair for them to say I'm borrowing the same amount of money as a mortgage, hundreds of thousands of dollars, if not millions, and they're not getting any benefit if they don't qualify for the technical deduction IRS offers, which is called the investment interest expense deduction. That deduction basically says you have to put the money back into the market to get the loss deduction, and most advisors are never going to do that. So that's a big gap, and we help to turn that into capital gain. We structure the transaction differently to get capital losses out of the financing expense. So that tends to be a big advantage from after-tax borrowing cost. There's a lot of flexibility advisors want as well. And I guess I would say flexibility comes in the ways to structure the loans. By that I mean clients want just what they can find from banks, right? If I'm buying a house, I want this to look like a mortgage in terms of the rate structure. I want fixed rate. I don't want the month-to-month floating. I want ability to pay less per month. I don't want have that money pulled out of my bank account to cover the interest each month. I want to maybe defer it. And banks usually are pretty strict. Margin or securities-backed lines are often floating rate. every month they will sort of like deduct the interest off you, and you have to like make up the payment for it. And the collaterals are kind of stuck there. Basically, they put a restriction on your account. You can't take money in and out. It's stuck there for the collaterals. And everything needs to, like a third-party lender approval letter, and the advisors sort of just, they're not a fan of that process. I don't think anybody is. We sort of just do this differently. Because we're able to do this on the market, we're able to structure these with different instruments on the market, allowing payments to be deferred to the end of the term. And we can get either floating rate or fixed rate, anywhere from like month to month floating, 3 months, 6 months, all the way to like 1, 2, 3, 4, 5 years. As far as 5 years out, clients don't have to worry about interest rates changing. They don't need to worry about Iran happening and runaway inflation happening just like the 70s, and then suddenly they have to like deal with a loan that's very, very expensive. And they have that certainty, that peace of mind. Speed is definitely a big part too. We don't have any kind of like bank-style application process. Usually banks they're prudent because they're regulated tightly, and they need to be cautious. They want like your personal information, credit report, a bunch of things. Here we're just what we do is we help the clients access the box spread market. That is exchange traded. So it's the same thing as trading a piece of stock. There's no application form involved. The client really just like, they tap into this existing pool of liquidity that I think most people don't know about because it's just historically institutional. Like, it's been around since the 90s, but it only became retail accessible after 2021. So that's where I think it's really interesting. We're trying to like out-compete some of our alternatives on all three aspects.
Fantastic. But let's look at the portfolio level a little bit, because clients typically borrow against portfolios for a few core reasons. What's the most common use case you're seeing advisors prioritize right now?
Everything is the house. It's strange, but like with lending, like, and with those use cases, we see just like the real estate use case come up again and again. That could be a primary residence. That could be a vacation home. It could be, fixing up the kitchen and renovate everything. But it's always the house that comes up. I think we probably have like over half of what we do with advisors are some sort of like escrow, closing, time-sensitive use cases. What we often see with clients is they're trying to buy like a fairly expensive piece of real estate in New York, California, or here in Florida, worth a couple $1 million. If they're getting a traditional conforming mortgage or jumbo mortgage, they're only able to write off the interest up to $750,000 in principal. But a house here in Florida or where I'm from, in San Francisco, it's going to cost millions. And most of the mortgage interest they pay is going to waste when we think about tax dollars and tax deductions. So that's where advisors get smart about it. Sort of put in what we do with the box spread strategy that we at SyntheticFi offers, and that allows them to get deduction above the 750 cap. And that's really powerful when you think about the financing package being such a big piece of the client's liability on the balance sheet. And now the advisor can optimize both the assets and the liability side.
Well, this certainly makes the case for advisors to be working with you in SyntheticFi. So, Tony, thank you so much for your insights and your perspective today.
Thank you, Shannon.
For Wealth Management, I'm Shannon Rosic.